Hello, this is Chuck Carnavan. I'm the Chuck in the Markets Up Chuck. And today this blog was entitled Utilities for Income with a big question mark. You know, are utilities a good alternative with interest rates being as low as they are? You know, you can find utility stocks that are paying, you know, close to 5%, and I'm going to show you a couple that are paying a little more than 5%. Is that extra couple of percent in yield actually worth the risk you take? Now I'm going to take a look at three different utilities. I'm going to start with Dominion Resources. I want you to notice one thing about utilities. They tend to have very low growth. This company's grown at 4.5%. This is a 20-year time frame going all the way back to 1991. I want you to notice the stock price has been very consistent. The light blue area shows the dividends, and they have paid an attractive dividend. You can currently get a 4.7% dividend yield as of yesterday's closing stock price. Over the last 20 years, I want you to notice that the dividend has increased, but it hasn't really increased that much, not as fast as some of the growthier stocks that pay a lower dividend yield but are growing faster have done. But you can see over a 20-year period, a $100,000 investment would have generated $160,000 in dividends. You would have doubled your money, and you know, of course, that's actually slightly less than the general stock market, but better than a bond. Keep in mind, if you bought a long-term Treasury bond, your yield would your value here would only be par. But you know, the question is, going forward, this company is expected to grow at about 5% a year. And so if you were comparing that to buying a 10-year Treasury bond today that's only yielding 3.4%, the Treasury bond on a $100,000 investment would generate $33,000 in total income. This is in the hand. This is guaranteed by the full faith and credit of the U.S. government. This is simply a forecast. If you bought Dominion Resources, the estimated dividends, assuming some growth at about 5% like it's historically done, would throw off about $56,000 in total income. So is the $56,000 in income in the bush, worth taking the risk versus getting, $33,000? And of course, the other side is $33,000 enough? Is it worth taking the risk to get to $56,000? These are questions investors have to answer today. Another well-known utility is Consolidated Edison, and as you can see, Consolidated Edison yields slightly more, about 5.6%. It's been a very slow grower, 1.7% growth. One thing I want to point out, when you're owning a utility stock, there is going to be price volatility. You can see the price was, $24 in April of '91, then it got up to $36, and then back down to $25 by 1994, back up to $31, back down to $27. But if you look at the highs and lows, I want you to notice that, there hasn't been really a whole lot of growth. You could see, it's a $32 stock, and on the low in 2009, it was a $32 stock back in 1993. So keep in mind, these companies don't generate a lot of growth. However, if you look at their long-term track record, $100,000 investment would have thrown off $173,000 in dividends. Your yield would have increased not very dramatically, but it would have increased over the years. And you'd have certainly done slightly better than a long-term bond at that point. Again, if you compare that to Treasury bonds today, the yield's a little higher, and the growth rate is about 4%. So you could expect 69,000, or at least you could hope for 69,000 in estimated dividends on this company versus 33,000 guaranteed by the full faith and credit of the U.S. government in the Treasury bond. And the question is it worth it? I think the other point I want to make is, when you own a stock like this, you have to be willing to ride through some volatility, because volatility is certainly part of it. A company that, another well-known Southern company, utility stock, named Southern Company, has a kind of a very interesting picture too. I want you to notice a very consistent, growth of only about 3.3%. The stock price does have its volatility. The highs and lows, again, stay pretty much range-bound during this period of time. It's only been a 3% grower. And once again, you're going to see a nice dividend, a little bit of capital appreciation over the long run. But again, the question is, if this company is expected to grow at just under 5%, is this, possible dividend, which is again a forecast and not necessarily just simply a mathematical calculation, may or may not occur? Is it worth taking the risk to get that much more income when you can get a Treasury bond, full faith and guaranteed? And of course, as I said earlier, the question is the $33,000 enough, or is it so low that it's going to force you to take more risk? But this is the reality of what utility stocks actually look like long term. They do pay nice dividends, but they're not really great total return investments over time. They are more competitive with a bond than they are competitive with a faster growing company. For example, if you compared this to something like let's say Colgate-Palmolive, which has a lower dividend yield but a much faster growth rate. You can see that Colgate-Palmolive has grown by 11%, only has a 2% dividend yield, but it actually threw off over the last 20 years almost as much income, but obviously the rate of return was significantly better. And when you're looking at it for estimated dividends, it's not going to stack up to a treasury bond. You're looking at more capital appreciation. Now, this is Chuck Harm. I hope this gave you some extra insight into owning utilities. Look forward to talking to you again tomorrow.